First, let's talk about all the big cues that we've been getting in over the last couple of hours. Jahangir Aziz, global head of EM Economics at JP Morgan, is with us. Jahangir, great to have you with us on the show. I don't even know where to start. The rise in US yields, S&P, upgrading its outlook on India or the elections. So let me throw it all in. I mean, we're running into a lot of major data points and events. But let's start with the US, actually, where the 10-year yesterday moved to 4.6, and then we're getting inflation numbers tomorrow. How do you view this rise? And do you think this is just the market repricing a newer reality of rate cut expectations? Is it done? Or could there be more to go?
So look, I mean, I think the move yesterday was, or this morning, was largely a reflection of the issuance, of the heavy issuance that took place. And I think it is much less to do with any repricing that the market has done over the last 24 hours. I think the market clearly has moved away from expecting too many rate cuts. I think the market is now probably has one and a little bit more for 2024, mostly in the second half of the year. We continue to believe that the economy is probably going to show enough signs for the Fed to tick the boxes it needs to start cutting somewhere in the second half of the year. We have a July rate cut. The rate cuts starting in July, and we still have 3 rate cuts for 2024. But clearly the risk is on the other side, right? That you could, if the core PCE numbers do not pan out or do not show a continued softening, and if we do not get, and if we get another upside surprise in non-farm payroll, then clearly, the July rate cut gets pushed down, and we're probably, closer to 2 rate cuts rather than 3 rate cuts. But for now, we do expect the activity to slow down, not slow down any precipitously, but slow down sufficiently for the Fed to feel comfortable that they could start cutting rates.
Okay, Jahangir, hi, good morning. Well, that's about the US Fed, right? Back home, we have our own issues to deal with. There's the MPC meeting on the 7th of June. There is, of course, the election results as well. Post the election, there's a big union budget perhaps coming up in July. So what is the expectation this time? If the RBI does maintain interest rates in this policy because of, a stable inflation scenario, when do you expect the next move on rates to come, and what should investors look forward to?
So we have pushed back, rate cuts in India. Part of the pushing back of the rate cuts is probably to do with that we've also pushed back the Fed, right? So the view has been that not just India, but India, Indonesia, the Asian central banks did not raise rates as much as, let's say, the Latin American or the European emerging market central banks had raised rates. So their margin that they have to cut rates is actually pretty slim. And given the fact that the dollar strength hasn't really ebbed, in fact, the dollar has continued to be, on the strong side. You've seen a steepening of the U.S. rate yield curve, as we spoke about it earlier. I think the concern is that you do not really want to start cutting rates before the Fed does on concerns about financial instability. So our sense is that if we have a July rate cut, then probably August, September is the time, or August is the time when the RBI could start cutting rates. But look, the rate cutting cycle in the case of RBI, as in the case of other Asian central banks, is going to be very shallow, unless, of course, the Fed surprises out with a significant easing in 2024. But if the Fed is going to give you 50, 75 basis points of rate cuts, then the amount of rate cuts in India or in other Asian central banks is going to be, probably about 25 to 50 basis points.
Hi, Jahangir. Good morning and good to see you. And how are you reading the Chinese data that's coming out of there? We had the IMF yesterday going ahead and upping their growth guidance for China. Do you think China's coming back or do you think you're not really convinced?
We are not really convinced. We are not really convinced for the fact that if you go back 2017, 18, 19, 20, 21, 22, 23, all these years, right? You typically had in the previous year, in the fourth quarter, the Chinese providing a significant amount of stimulus, and that stimulus would carry through in the first half of the year. first half of the year, the growth numbers would be reasonably strong. Q3 would be the time when the growth would slow down and the Chinese authorities would come back in Q4 with another round of stimulus. That happened in 2023. And the amount of stimulus that was provided in fourth quarter of 2023 was reasonably high. And as a result of that, we got a very strong growth surprise in the first quarter of this year. The problem this year has been is that 2Q already looks pretty soft. And 2Q softness is, mostly on the demand side, which has been the Achilles heel of China. And I think it, unlike previous years when the slowdown would take place in the third quarter of the year after the stimulus impact would go away, surprisingly, this year, the stimulus impact is already fading in 2Q itself. And if you look at Chinese growth, the bright spots just happen to be exports, which has very little to do with China itself, but has to do with much stronger European growth and continued strength in the US economy and industrial production. And so
Right.
we are not very convinced that we are going to get Chinese growth above 5% or near 5% without another round of stimulus coming through reasonably soon.
Okay. Jahangir, let's come back to India then. What did you make of the S&P upgrade to, not the rating, but the outlook? The fact that it's coming before the electoral results. They cited a couple of reasons. They said that they're very happy with the continued commitment to fiscal consolidation, the quality of government spending. So what do you think about this? And then, we are running into the mother of all major events. And how do you see India? We have GDP numbers coming out on Friday. That's just tomorrow. How do you see the entire juggernaut, the Indian juggernaut, rolling out?
So I think the fourth quarter, the last quarter of the fiscal year, is going to be a strong year. It's a strong quarter. It's going to be a strong quarter. Apart from anything else, there has been a significant amount of election-related spending that has happened. The question is what happens once that election-related spending fourth quarter boost that we get fades, and what happens in fiscal year 25. And we have a view that the economy clearly is going to slow down from what we had in the previous year, probably somewhere around 6.5%, 7%. That's where the range of growth, the ranges on the growth front in fiscal year 2025. But I think much will depend on two factors. One is, does the government, keep to the fiscal consolidation with a very tight spending, or does the fact that the RBI has provided them with, a reasonable amount of space to keep spending up and still make it to the consolidation target, does that become in reality in the July full year budget? I think that is critical in trying to figure out how growth is going to pan out. And clearly, the other factor happens to be what happens to the global economy, particularly what happens to rate cuts in the Fed. Without rate cuts, I think real interest rates will remain high. Real interest rates in India, given the fact that inflation, at least core inflation, has been coming down or has remained very, very, very benign. Real interest rate in core terms has been much stronger than what you would expect for an economy, going into fiscal year 2025. And I think these two factors will sort of decide whether we are going to break 6.5, 7, or we are going to go below that. So I think it's the fiscal will the government manage to keep to the fiscal budget target without having to cut down spending, given as I said, given this the space has been provided to them by the generosity of RBI. I think that becomes the key, and we'll have to wait and see what the July budget holds.
Okay, Jahangir, thanks a lot for that. So that's really a lot to look forward to, and major events coming up for the market. But